Welcome to the Cashflow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cashflow Project Podcast. I'm your host, Steve Fierros with Tri-City Equity Group. Excited today, we've got Tad Fallows on the show. So Tad is a co-founder and managing director of Long Angle, a private peer community for very high net worth entrepreneurs, executives, and professionals across 45 countries. Long Angle facilitates knowledge sharing, collaboration, and investment opportunities for its 5,000 plus members while prioritizing authenticity, confidentiality, and a strict no solicitation policy. So membership to this group, super exciting, guys. And we're going to talk a little bit about that later. Of course, Tad's got experience in a number of different ventures as well. We're going to dive into some alternative strategies. Obviously, we all know real estate, so we can talk a little bit about that as well. But Tad may be able to shed some insight onto some alternative investment strategies that may be worth your while and worth to listen. So excited to have him on. Tad, welcome to the show.
Hey, thank you so much for having me today, Steve. Really excited for this conversation.
Yeah, absolutely. No, we want to try and bring as much value to our listeners as possible. And one of those is, of course, bringing on experts such as yourself that can shed insight on, like I said, alternative investment strategies, maybe stuff that most listeners aren't aware of. Everybody's exposed to the tried and true real estate and, okay, how many legs of a stool do we have here? What are we invested in? We've got the broad-based exposure to S&P and we've got some real estate portfolio. Okay, but what other kind of investment strategies do we have? But before we get there, give me a little bit about your background. How'd you get started into this? Is obviously you operate in a unique space. And so that didn't just happen by accident. And so I'd love to hear a little bit about your story and how you got started.
Yeah. So my journey to investing actually really came by way of entrepreneurship, where shortly out of college, I decided to start a software company with a couple of friends of mine. We ended up bootstrapping that because we started it right around the GFC. So there was the venture capital markets were closed then. I think in retrospect, that ended up really being a good thing for us because it forced us to think a lot more about profitable growth and not just growth than most startup companies do. So we ended up growing that software company for about 10 years. We grew it to about 100 employees without taking outside funding. And then we sold it to a big strategic acquirer in the Bay Area. And what that meant is my kind of professional training was mostly just learning how to grow a company and go from, okay, the three of us do everything to, okay, now I'm doing sales. Now I'm running a sales function. Now I have somebody else running a sales function. I'm managing them, et cetera. Same with legal or HR or what have you. So that was a really great professional experience. But then from a personal finance experience, what happened was I went till my mid-30s basically making no money and all of my net worth in a single illiquid microcap stock. And then one day I got a diversification event and okay, now I have a lot of liquid assets to think about managing. And it was a pretty abrupt transition on one day to a variety of kind of high net worth questions, both those investment questions, but actually a whole variety of other things. Okay, how do you make sure that wealth is an asset, not a liability for your kids? And how do you think about estate planning? How do you think about fitness or travel if you've got a bigger budget to spend it on, all that sort of thing? And what that led me to was actually starting this group that you mentioned, because I had a number of friends who are in the same situation of, okay, I suddenly have a lot more money than I used to have. And all the advice for these sort of esoteric high net worth or very high net worth questions is coming from a Goldman Sachs or Credit Suisse. And I want to get that advice from other people in the same situation who are not trying to sell me anything. So that's why we started this group. And then specifically on the investing side and looking at private markets, a lot of that is, I would say, if somebody is at up to a few $1 million of net worth, a lot of these things like private equity, private credit, litigation finance, hedge funds don't really make a ton of sense because they often have very high minimums, even in the millions or tens of millions of dollars minimum investment to a single vintage. And it is not necessary to run a good portfolio. If you put 100% of your money into the S&P, you will have done fine and you'll probably continue to do fine. If you do some basic diversification into real estate, as you're talking about, maybe some bonds, again, you've got some diversification. But since I got to the position where some of these things did start to make sense as to both diversify and increase expected return of the portfolio, that's when I got into it, and happy to talk a little bit more about what I've learned on that journey.
Yeah, for sure. Now, we often talk about, I do a ton of networking. I've been to a million conferences, and we host meetups here locally in Hawaii. But yeah, it's what I tell people all the time. It's okay. Like once you start, if you're successful at anything, you end up with different problems, different challenges to overcome and to tackle. Tax becomes a huge deal. Okay, how do I shield and shelter? And then obviously you talked about asset planning or planning longer term. Okay, you got kids. Like how do we make sure all of this works? Estate planning and all the mechanics work. So that's awesome. And most people, I feel like, of course, entrepreneur space can be very lonely too, right?
Yeah.
But that's awesome that you guys were able to have a small cohort where you're like, okay, we're on the same boat. How can we do this better? Right? How can we learn? How can we learn from each other's experiences and exposure and conversations and connections and leverage that to everybody's mutual benefit? So I think that's awesome. But yeah, before we get there, of course, I'd love to hear about some of this alternative investment strategies. Again, now a lot of this stuff, just talking to our listeners, again, you'll never see this if you're not around those specific types of circles. So just like Tad's talking about, hey, somebody wasn't having that conversation with you, to your point earlier about without pitching you. It's okay, let it have a conversation, but don't try to sell me the product. Can you look out for me and my best interests without making some money off of it? And of course, that comes a little bit more organically through the connection point. So that's awesome. But yeah, what are you seeing out there? What's popular right now? Would love to dive into some of that.
Yeah. And I should say, my context coming at this is that a lot of our members are in this situation of saying, hey, maybe I've got 10 or $15 million. And so I am interested in most of that I'm going to put, say, into S&P 500 or real estate or something I can self-manage. But there is a set of that I want into stuff like private equity or private credit, and maybe call it 20% of my portfolio. And what people are saying is, hey, individually, I can't write a big enough check to get into this. And also individually, I cannot responsibly due diligence one private equity operator versus another. I just don't know anything about it. But we can do that collectively, where if we have 7,000 members, so maybe a given private equity fund with a 10 million minimum, 100 people each want to put in 100,000, so that we can collectively hit that $10 million minimum and get either access or preferred fee terms or what have you, but doing that collectively. And we don't take any sort of kickback from the sponsors. It's really just about trying to find, okay, what is the best in class version of this? So the idea is to say, hey, there's a number of interesting private market assets out there. And I would say the way I think about private markets is probably two things. So one is just your diversification. Everyone has access to public equities, which is a fantastic long-term investment. Historic returns of, call it 10%, and extremely low barriers to entry, great full information. The SEC is watching out for fraud. If you just close your eyes and throw darts at a wall, you're going to do just fine. So that's a great asset class. But the problem is, if that's all you own, it's all correlated to itself. So if the S&P has a bad year, you could be down 30% your whole net worth. And some people are willing to stomach that for the 10% expected returns over the long term. You do fine. But the sort of free lunch in investing is diversification. So if you can find multiple asset classes, maybe you say, hey, real estate with appropriate leverage also has a 8% expected return, or maybe 10%. So I'm not giving up any expected return. But now if I'm half in real estate and half in public equities, I still am expecting 10%, but it should be a less volatile ride, because when one is up, maybe the other one's down, and they're somewhat correlated, but not perfectly correlated. And the idea of these other private asset classes is to just expand that idea and say, okay, well, if I also add private equity, and I also add hedge funds, and I also add litigation finance, and also oil and gas, if they all have a 10% expected return and they're all less than perfectly correlated, I'm not going to change my expected outcome, but I'm going to get a smoother and smoother ride along the way, which either just makes me feel better emotionally, or maybe I actually can improve my returns, because if I'm just not willing to handle that 30% potential down year in the S&P, then I have to keep some money in cash or bonds or a low yield instrument. Whereas if I decrease my worst year by diversification, I can have more money exposed to these high return assets, or a bigger share of my portfolio exposed. And it can actually go one step further, where some of these, if you look at private equity, for example, its historic returns just factually have been higher than public equities. So if public equities are 8 to 10%, private equities are even a few percent better than that, maybe low teens. Now, we could get into a detailed argument that's not very interesting to your listeners about exactly how long can that be sustained, and exactly where the driver is, how much is leveraged, blah, blah, blah. But on average, the returns have been good there. And there's a reason that things like university pension endowments and pension funds allocate very heavily to it, because the historic returns have been better to date. So maybe you can actually it's not just mute the volatility, but actually increase the expected return. But that's the basic philosophy. So if your listeners are familiar with the idea of, or even if you're a total real estate guy, you're probably not only multifamily or only office or only shallow bay industrial, what have you. People realize, hey, there's value of diversity, because you don't know when COVID's going to hit and destroy one sector and then help the warehouse sector. It's impossible to predict. So I'm going to diversify. So same idea extended. And then I think the other thing with private markets, and again, your folks coming from real estate will get this. If you look at the stock market, nobody can beat the stock market. and I'll leave Warren Buffett aside or something, but you and I are not going to do a better job. If we pick NVIDIA, we got lucky, and then we're going to pick pets.com to go along with it, and we're going to get the average return. But in private markets, people see this with real estate. There are people who consistently get better returns than others on real estate because it's not this perfectly efficient market where you've got all these PhDs with warehouses full of servers in Connecticut optimizing the price to the last penny. If I find a house down the street that's underpriced, I might just buy that house down the street underpriced, and a hedge fund didn't drive up the price because they're not playing that game. And so it's the same idea that private markets is a place where the legwork can actually be worth it. If I actually go there and spend a lot of time getting to know all these different venture capital firms, and I see that Sequoia has better returns in this category than somebody else, I will actually just get that tailwind of better returns because there's imperfect information. It's hard to access. All those friction points can actually deliver outsized returns. So that's the other thing with it. It's a place where you have to do your homework in order to invest responsibly. And again, real estate, I think people get that. If I just randomly buy, I don't care what it is, I'm buying 10 square feet. If I buy 10 square feet of Class C office buildings, I probably didn't do real well. And that same concept there. And that's part of the reason that we think that the other economy of scale beyond just hitting this $10 million minimum to invest in a fund is we can then collectively do that diligence where we hire a half dozen investment professionals constantly building these relationships and doing the underwriting. And then we actually also draw on the expertise of our community where, let's say if we're looking at oil and gas, we've got a dozen members who run companies in the Permian Basin. So if we're saying, hey, which of these oil and gas funds is best? It's not, hey, here's the one that's marketing to dentists. It is, okay, the guys who live in Lubbock and have been doing this since they were born, and their granddaddy was born on a farm in West Texas, they're the ones saying, okay, this is the best in class operator. And that helps. The same thing apply to any other asset class. We have some members who work in it and help share the expertise so everybody else can take advantage of picking best in class.
Yeah, no, absolutely. And that's the unfair advantage, right? You're leveraging the time and experience and skill sets of everybody else, not just, okay, I'm going to throw a dart at the wall and say, okay, this operator seems like they're legit. But you've had 10 other guys in the community that have had exposure to them, know them personally, or know them in the industry, and then say, actually, I know they've got some issues going on with them, where there's smoke, there's fire kind of deal. Yeah, maybe stay away from them for a little bit or do a little bit more homework. That's awesome. Yeah, and you mentioned it earlier. We talk a lot about diversification, even amongst real estate. And so it's okay, like geographic diversity, right? I'm based in Hawaii. Like we're literally thousands of miles away from the middle of the Pacific. When COVID shut everything down, it's okay. We're heavy dependent on tourism. Well, when the state shuts down, guess what? All of that tanks because there's nobody coming to the islands. The government won't let them. And we were totally fine because we're diversified across multiple states, across the mainland and different asset types, and say, no problem. We were just going to buy more there. But a lot of people just, again, if you don't have that mindset or you're not comfortable doing that, or you just don't, and a lot of times even the comfort level, just you don't know anybody that's doing it, right? So you don't know how to have a conversation with them. Like you don't know what you don't know. And so I'm glad that you're able to bring some of that insight into our conversation here, and we can expose some of the listeners to that. Oh, I never thought about that. Oh, wow. Wait a minute. There's opportunities to invest onto financing for legal or for medical and like all of these different alternative investment types. I think it's awesome.
And I'm happy to share, if your members are interested in cash flow, I can talk about a couple of asset classes that I think are interesting. And I'm not pushing a particular investment here. This is just, we intentionally look across the whole waterfront for this purpose of diversity, where we say, hey, in a given year, we'd rather bring one excellent private equity deal, one excellent venture capital deal, one excellent oil and gas deal, rather than all in one category. So we're just looking for top decile. So I don't have a dog in the fight on which asset classes people choose, and different ones are right for different people. But I know a lot of your listeners are interested in cash flow in particular. And I would say for them, real estate is a great asset class for cash flow. So I'm not trying to talk anybody out of that. I think it is a great way to go if that's what you're interested in. It probably depends on the season. When is a great time to get into real estate and when is not? I think COVID was a fantastic time to get into real estate because they're giving away money at 2% loans, and then they are giving away money to drive inflation up to 5%. It's kind of like you can't lose in that dynamic. But there's other times when it's less attractive. But beyond real estate, what I would say, a couple I would look at, one is called private credit. And really, it's what the name implies. So it's a private thing. You can't go buy a public share of this. And then credit, so it's lending. And so it's really, if you are a corporation looking to borrow, you've got basically three options. You can go to a bank to get a loan. That happens somewhat, but outside of real estate, I'd say it's not nearly as big in the US as it is in a place like Europe. The second one is issuing bonds. That's a great way to go, and it's cheap, but that tends to be really for big companies. So if you are Google, you can issue all the bonds you want at really low interest rates. But if I'm running a $100 million manufacturing company, I can't really go issue bonds. I'm just too small for it. So the third option is private credit, where rather than borrowing from a bank, you're borrowing from this private credit fund. And their whole business is to loan, again, to more toward these medium size, I wouldn't say truly small companies in general. It's not like a corner bodega, but it's, again, your $100 million manufacturer would really be the typical private credit borrower. And often you are funding a private equity buyout where, again, if that manufacturer, some PE, let's say KKR comes along and says, hey, we want to buy this firm. Just like in real estate, you don't pay all cash. Typically in private equity, you don't pay all cash. Maybe you put 30 to 50% equity and you borrow the other 50 to 70%, and the person you're borrowing it from is private credit. And typically the reason people like it is a couple of reasons. One is the interest rates are pretty meaty. I'll say it depends, of course, on the underlying Fed funds rate, but historic returns call it maybe 8 or 9% for the more conservative end, getting up into sort of the mid-teens for the somewhat more aggressive end of it. So very healthy interest rate or yield on it. And then historically, again, there's lots of arguments about will this persist, but historically pretty low default rates. And of course, what you're looking for is the expertise of people who pick the low default rate ones, and also the ones who have the expertise to take the keys if things don't go well. Real estate is great because if I default in my apartment building, you can seize it. There's a very liquid market for that. You can get your money back. It's not as liquid a market for these companies. So if you're a private credit operator, you really either need to be excellent at your underwriting so that they never default, or if you're not 100% excellent, you need the ability to take control of that thing and run it profitably yourself and turn it into a home run because now you're in equity position. Private credit's interesting. One watch out I would give there is not a tax efficient vehicle. Most, not 100%, but most of the income is going to be ordinary income. So that's if you're a high earner in California, you end up paying 50% tax on that. So maybe it's a headline 13%, but then you're making 7% post. It's okay, but it's not as phenomenal as the 13% sounded. One, at risk of getting...
Too,
yeah,
I was just going to say, just to add some context there for our listeners, for something like that, just think of it as like a scaled up private money lending. A lot of our listeners will be familiar with, okay, hey, I'm issuing, hey, somebody's got a project, they need 50 grand or 100 grand or whatever for PML. Okay, great. This provides an opportunity for you to come in with that single operator on that single deal, obviously for a specific period of time. Obviously, you dictate the term. So they may be more familiar with it on that side versus this is a scaled up version. Obviously, for
this
much
is a big
larger
fund.
companies.
The biggest ones having tens of billions of dollars they're lending out. It's a real portfolio approach. They've got it should at least be much less single asset risk than you're talking about. If I lend to a single building, go belly up. There's no world where Golub, their whole $50 billion portfolio defaults. You're talking about, okay, the default rate's moving by a percentage point.
But just so they can wrap their hand around it, because I know it's going to be a new concept for some of our listeners, and it's just, okay, they have zero exposure to this, but the concept is still the same. It's very similar. And just like PML, just like you're saying, Tad, like this doesn't come with the additional benefits of the tax. And so this is literally, it's a cash flow play. It's not, you're not getting tax benefits off of it, like you say would if you own the real estate. But that's the same thing if you're dealing with PML. It's really no different.
Yeah. And I would say you can get a little more creative here. Some of it's pretty interesting where maybe the asset that's backing it is not necessarily a company. Maybe it's a bunch of barrels of whiskey in a vault. Maybe is a future stream of royalties on a piece of music. It can be, maybe it's future stream of royalties on a software company, a bunch of stuff like that. And often if you really play in these niches, you can find higher returns. Like maybe if you're doing this into cannabis operators, banks can't lend to them because of these federal regulations. So you can actually get a lot better security. Maybe it's also real estate backed and this cash flow positive businesses who just need to borrow and they're willing to pay more because they're operating in cannabis. So you can get pretty esoteric here, depending if you want to, or you can just go more conservative mainstream and get your sort of high single digits as opposed to double digit returns. And I think if you have a very large portfolio, you can look at certain things to do tax mitigation there, like putting inside a private placement life insurance policy, which is, I'd say, completely different from something like whole life or VUL, which I'm not a big fan of. It's not a high fee vehicle for private placement life insurance. Problem is it's a very high minimum vehicle where you have to do $1 million a year of premium for multiple years, unless you can figure out a way to take that down. So private credit is one. Another one that I really like for cash flow is energy. And by that, the fossil fuels. The reason I'm not just saying oil and gas is there's a few different pieces to that ecosystem. So the same way real estate has a number of subsectors, I'd say oil and gas has a number of subsectors, one of which is the pipelines that just move, oil and gas around. Often people access those actually through the public markets of master limited partnerships or MLPs, where you can get high single digit yield on a publicly tradable security there. And often you'll get appreciation over time. So that's interesting. Or if you get in the real exploration and production side, a couple of options there. One is you can just buy basically mineral rights, where the idea being there's a piece of land somewhere in Texas or North Dakota or whatever play you want to play in that has a bunch of oil and mineral deposits underneath it. The U.S. is actually really an exception here, where the person who owns the surface owns all the surface rights. Most countries have decided that those belong to the government as a whole. But here we say, hey, that belongs to whoever happens to have the farm on top of it. And so what you can do is you can actually just buy a piece of those mineral rights. So if I own the mineral, I don't have to actually buy the ranch land. I'm just buying the minerals underneath the ranch. And so now Chevron comes and drills that. I get a certain share of the production that's produced there. I don't have to pay, I don't take any of the risk of they drill and it's a dry well, or they drill and they cause some environmental damage, or they go over budget, whatever it is. I'm just getting a royalty share of every dollar, every barrel it's produced. Maybe I get an eighth of the revenue from that. That's probably the lower risk, lower return version of it. Again, it's something where I would only go with a really good operator, because it's all about getting the right information here. So your ideal one is I'm buying a piece of land that's not currently producing, so there's no cash flow I have to pay there. I'm paying for potential, but I have information that it is going to be drilled very soon. And as soon as it gets drilled, that spikes the value because you turn potential into actual cash flow. And if you are, one rule of thumb I have is I only invest in oil operators who are based in Texas, because I don't think a guy based in Seattle they say no good deal leaves the Permian. And so I want to invest with people in the Permian who are seeing those opportunities. And again, they have those sort of lifetime relationships there. But regardless, I think that is a lower risk one. And again, I'm not saying no risk. If you borrow all the money you're investing and then oil prices go down, you're still making some money, you're making less money, maybe you can't cover your interest payments. But if you do it all cash, relatively low risk. And then I would say there's the actual operating of drilling side, and getting into a lot of nuance here where you buy different versions of it. But generically, what you'd be buying in this case is you'd be investing in somebody who actually does the drilling and does the production. And that's where you have probably the highest potential returns. And again, if you go with this is probably the one where it's most important to go with a great operator, because the actual return on equity of a drilling activity can be extraordinarily high. Talk about like 70% return on equity of actually doing the drilling. So phenomenal. But there's a whole bunch of ways it can go wrong, and you have to make sure that you have a very strong operator who's executing everything right. So do they really have their geology right? So they are sure when they're drilling, there's oil underneath it. Do they have their hedging? So if I'm drilling today, have they actually protected myself from oil price volatility or not? Do they actually have sufficient scale? And scale can be $1 billion. Because if you're thinking about these rigs, it could be like $500,000 a day to have a rig. And it takes maybe a couple weeks to drill. It depends. Let's say it takes 10 days to drill, something like that. That's $5 million right there. But if I actually want to get efficient, I want that thing running for 6 months or a year, just going down the line, punching well after, when I don't pay for any of these days of transport cost or idle stuff, and I can afford to do everything at scale. So again, scale could be $1 billion in this case, because I need 10,000 acres and I need this thing, and I need to be able to hire the best geological engineer and all that sort of stuff. But if you do that right, again, you can get phenomenal returns. And one thing that I just think the science and technology here is fascinating, but one thing that a lot of people get scared away, they say, hey, oil, it is risky, but it's not risky maybe for the reasons it was 30 years ago or in their minds. 30 years ago, you might say, hey, there's a ton of geological risk. In theory, I'm looking for this little pocket of liquid oil somewhere 3 miles down. I'm sticking a straw into the ground and hoping I hit it. It's really not what it looks like today. People probably heard the term hydraulic fracturing or horizontal fracking. But what that really means is you're no longer looking for that pocket of liquid and gas. What you're looking for is the so-called source rock, which is just this long horizontal piece of rock, that's oil-soaked rock. And now today you drill down there, and then you turn 2 miles down your drill bit sideways, and you go sideways for a mile or two through that. And then you fracture the rock so that all that, it's kind of like a sponge, and all that starts oozing into your pipe and goes up to the top. And the reason that's relevant is far, far more predictable how much oil you're going to hit. If these well-developed basins like the Permian Basin, but there's other ones, the Eagle Ford, Williston, et cetera, you know exactly where the oil is. And if you're in this county or you're in this acreage, you know what's going to be down there when you drill. So you really, if you do it right, you're taking care of the geological risk. And then the other thing people worry about is, well, oil is a notoriously volatile price. There's a famous bumper sticker back in the Permian some point in the 80s, like, give me one more boom and I promise not to piss it away this time. And so price goes all over the place. But what happens today is, because this horizontal fracking, the production is much more front loaded than it used to be, where your first couple of years of production, you both know what you're going to produce, and you're going to get most of your lifetime production the first couple of years. And the reason that's important is both everybody likes cash flow early, but you can also hedge out your first couple of years of production. I can't buy a futures contract on oil 10 years from now. That doesn't exist. But I can enter a futures contract for oil 12 months from now. And so then what I can do is I say, I know I'm going to produce 10,000 barrels in the next 12 months. I'm just going to go ahead and sell 10,000 barrels of future production today. So I'm not going to get the upside if there's war in the Middle East, but I'm also not going to get the downside if there's another pandemic. And if I can lock in a 70% ROE, I'm perfectly happy to give up my 1,000% upside. What's interesting, though, is actually most operators aren't. Everybody in the oil industry is a perma bull on oil. They all say below 60 is not sustainable for the Saudis. It's not sustainable for us. It's going back up. And so it's actually surprisingly hard to find an operator who is really disciplined about actually getting their hedging, as an example of why it's important to really be selective about who you're working with.
And so much of this too, right? I think it's fascinating. I'd be curious too, just feel like I've seen more now, like with all of the AI, our push towards more and more technology, obviously super energy intensive, right? And so it's okay. And obviously too, some of this is going to be dependent on, current administrations in office, right? Like what kind of policies that they're adopting, what kind of tax incentives and whatnot that they're extending. So I'd be curious too, like what are the terms look like like length of time, right? Term wise.
It's a great question. One, I'd say, I think the political risk is actually a lot less than you'd think, where, for example, the Biden administration, there's a lot of noise about clean energy, and generically, probably everyone would agree that a Democratic administration can prefer less fossil fuel, but they didn't really do anything that actually impaired. If you talk with guys in the oil business, they made more money in the last 10 years than they ever had before. So it's actually, that tends to be less of a change in economic practice than it is in just sort of general vibe shift. You're right about when you have production, you have both your liquid gas or your liquid oil and then your gas, natural gas. And actually, historically, people prefer the liquid oil because you get how it works. You turn to gasoline, et cetera. Natural gas is harder to transport. You need these pipelines and, the different things with the pricing. But in theory, data centers should be a real long-term increase in demand because natural gas is a great fuel to power a data center. And if the projections around AI taking over the world play out, we're going to need more and the U.S. has been a huge producer and explorer of natural gas with this fracking revolution. And often the gating factor has just been, hey, how do we actually get this to export markets? Because our price in the US is a fraction of the price for gas in Europe. But if we can consume more of it via data centers, that's a real tailwind there. So anyway, all that said, you're asking about the durations. That it tends to be a much shorter duration than, again, if you think about, Exxon's going down to Guyana and doing a 15 or 20 year project in offshore drilling, those are super long-term projects. I wouldn't recommend investing in those other than just buying a share of Exxon if you want to buy a share of Exxon. If you want to invest in more of an actual fund, you should stay in the US. We've got much greater political certainty. You're not going to have the state of Texas nationalizing your resources the way that could happen somewhere else. A whole bunch of reasons you should do it here. We've got great operators. We've got great geology. And again, with this fracking, it tends to make the timelines much more compressed where you gain most of your production within the first couple of years. So if you're looking at drilling a well today, it will continue to have a long tail of production. But economically, 5 or 10 years is sort of, it only takes a couple of weeks. You could buy the land. Theoretically, you could start drilling in a couple of weeks and then, you're producing and then most of your production is a couple of years. Your tail is really for all purposes by 10 years. You recapture that value or you could sell it to somebody else, et cetera. So it's not, I think, again, anybody in the industry who's honest will say, hey, climate change and transition to a green economy, that could well happen 30 or 40 years from now, but it has no impact on my investment today. And there is even the most optimistic environmentalist doesn't think that oil consumption is going to crash anytime in the next 5 or 10 years. If you look historically, the demand has been extremely smooth. You're talking about if the world consumes 100, 110 million barrels a day. Even during COVID, we're talking about going down a few percent on that. This was not something where it went down from 100 to 70 million barrels a day. So it's extremely stable. And you also have people like the OPEC and Saudi Arabia. I think as a kind of American consumer, they get a bad rap because, hey, these guys are trying to drive up prices. For the American production industry, it's actually not a bad thing because we don't have monopolies here. So everybody can just produce as much as they feel like. And to some degree, Saudi Arabia and others are left kind of trying to adjust their production to keep the global production in check. And this super annoys them. That's why they periodically try and drive the U.S. ones out of business because they're like, they hate the U.S. is now the biggest oil producer in the world and in history. And a lot of that is taking market share from these other countries and they don't like it. but they can't force the US to stop producing. So they have to kind of taper their production if they want to drive up price. Now, I don't think US production will last forever. Probably, unfortunately, from an economic perspective, I think it's been a huge tailwind for the US security and the US economy to be able to do this. But because we're so good at pumping out this oil, it won't be infinite. As of today, that opportunity exists from an investment perspective.
Yeah, that's what I was going to say. I'm like, okay, again, and you see the Saudis and you see a lot of these different, the Middle East countries pivoting away, right? Making sure that they're well diversified. None of these sources are infinite, right? And so it's okay. What do you do with it now? Obviously, that doesn't necessarily affect the timeline here for these investments. Hey, not financial advice. Hey, for all of our listeners, of course, like we're just two guys having a conversation on the internet. But my guess is I would be bullish also in the short term. I would imagine on most of these energy plays.
Yeah.
So,
and the other thing, I would say is I am somebody who cares about the environment. Some people just say, hey, I don't want to buy Philip Morris stock because I don't believe in smoking. That's perfectly fine. Sure. If you don't want to buy Exxon because, you're concerned about climate change, very reasonable. But the way I've looked at it as somebody who is concerned about climate change is that the amount of oil that gets consumed is really driven much more by the consumer than by the producer. So again, if we stop drilling, the Saudis are going to produce more. Their break-even costs of production are shockingly low. So I don't know if they could ramp it up to fully compensate, but at the margin, if we produced 1 barrel less, they would produce 1 barrel more. And then a couple other relevant things is that a lot of the energy intensity or the pollution, carbon emissions come from sort of the production process as opposed to just the end consumption. And then finally, the way I think about it is, would I rather this money is going to the US government and US investors versus Vladimir Putin and the king of Saudi Arabia? And there's a lot of bad guys who are the alternative producers for this. So maybe I'm justifying it to myself, but if I look at it from kind of what's good from the world, I don't think another dollar in the pocket of Iran and Russia and Saudi Arabia is a good thing. I think it's better off to keep that money here.
Yeah, because the demand is there. If you look at consumption from a global perspective, trust me, guys, like it goes to so many other places in the world. Everybody needs energy across the globe. So if you think that a lot of that kind of stuff is not going to get reallocated or readjusted somewhere else, don't fool yourself. Yeah, I agree with you. Yeah.
Like what we can do more of is cutting our consumption. I think that's where you're having, if I consume a barrel less, that doesn't mean somebody burns a barrel more. That's just a barrel less. So I think that's probably the place to focus the impact.
Yeah. It's personal responsibility too. It's okay. If you're passionate about it, awesome. You can make plenty of adjustments on what you do on an individual level. And then really that's what it would boil down to too, if you want to make some kind of changes long-term. But like I said, I think that's super cool. And I think that's just talking about the energy space in general. Like I said, I'm bullish on that long-term as well. Again, none of that, especially if we want the US economy to continue to grow and again, we need energy, guys. That's just the bottom line. Like everything that we want to make, to make happen in this country, and because of the global impact that we have, like you need energy. And so, I think that's pretty stable. That'd be pretty secure. And if you have an opportunity to invest in it and be able to capitalize that, like awesome. So now I'd be curious too. They're obviously one of the funds that say would be pooling investors together to invest into some of these different ventures. Is it going to be for, let's say, like that specific one producer, right? Like we're doing oil, we're doing this one specific project, or is that also fund type where, you know what, no, you have a little bit of allocation here because it's this specific asset type?
Yeah, so it's more the latter. I would not claim that I can go buy an oil rig and drill well. That is outside my sphere of expertise. But what I think I can be good at is by, again, doing myself and then leveraging our connections, saying, okay, this is an operator who is raising 500 million or $1 billion to go buy, probably not just one parcel of land, but probably they'll put together a small diversified portfolio of some land in North Dakota, some in New Mexico, some in the Haynesville, something like that. And they're going to have a thesis and they're going to be on their third or fourth one. So they've got a great track record. Hey, they've done this 3 times. They've tripled their investors' money each time. Now they're doing another one. And again, we'll do all that diligence of, do they have reasonable fee terms? Do they have track record? Do they have scale, et cetera? And then we will say, okay, we really like this operator here. We're going to invest with them. And also we look a lot about who are we investing alongside. A very good rule of thumb for me, if we are mostly investing alongside small retail investors, this is probably not an institutional investment. But if we are investing alongside the Duke Endowment, the Stanford Endowment, and the CalPERS Pension Fund, you shouldn't totally piggyback on the research, but it's a good data point that those professionals also came to the conclusion that the fees are reasonable and the returns or expectations are reasonable. So we will pick one of those and we'll say, okay, we're doing a $10 or $20 million investment there. And then anybody in our community, there's no pressure, but anybody who's interested will share all the diligence materials, say, hey, here's what we like, here's what we don't like, here's who it may be good for, here's who it's not a fit for, whether that's based on taxes or other factors. And then people will sign up for however much they want to. Maybe you want 50,000, I want 500,000. We'll hold that all together, and then we'll make that single investment into that fund.
Yeah, no, I mean, it's definitely a smart move. It's okay. Hey, where's the smart money going? Like, obviously you have these institutions that have much deeper pockets than you are individually. So it's okay. They're going to have a team established to go and do homework on research on, okay, what does this look like? What are the risks here? Put together a whole package on the investment opportunity, the prospectus. And so it's like, okay, if I can piggyback off of that, obviously I'm going to use my own resources and to be able to do my due diligence. And then, hey, if it's a smart move, great, let's move forward. But then you're leveraging resources of other people, which, guys, name of the game. If you haven't, to all of our listeners, if you haven't learned that, like to be a solo operator, let's say in real estate, like you'll be able to go, you can be successful, but you're only ever going to go so far. All the guys that I've ever interviewed, talked to, had conversations with, again, you want to leverage their resources as well, right? No one person has the magic key to all of it, right? So Tad has unique giftings and experience that I would never have, because again, he's lived a different life than I have, and vice versa. And so you want to be able to partner with people who are able to identify that, leverage their skills, their resources, their talents, and you can pull together cohesively. And so that's something I've seen people need to learn, being in, especially just starting out in investing. It's so easy to go alone, and we want the community. That's always a huge, huge deal for investing. And then a point of leverage. That's not just capital. That's time, resources, talents, expertise, experience, connections. So we want to be able to do that. And you can do that. It sounds like going this route, which is awesome. But we're at the point of the show where we have what we call our fire round, just a little bit more rapid fire, brief kind of Q&A, just a little more fun questions. And is that something you're up for?
Yeah, sounds good. I'll keep it brief.
All right. First question. What's a favorite book recommendation that you have for real estate investors? Obviously, that's the Purple Bible, Rich Dad Poor Dad. And it doesn't have to be business. It could honestly be anything. It could be mindset. It could be business. It could be whatever. Do you have some go-to recommendations that you have for people whenever they ask you?
Yeah, one that I really like is, so there's a guy named Dave Swenson who ran the Yale Endowment for decades, legendary investor, super successful. I really respect him because he didn't go to Wall Street and make billions. He made millions, but by making billions for Yale. And he wrote a book, and he really pioneered this idea of institutional endowment portfolio management, something called unconventional success, which he was just writing to the individual retail investors saying, hey, if you want to think about applying the relevant terms to your own portfolio management. So Dave Swenson is who I'd recommend there to think about portfolio construction.
Okay, awesome. Yeah, good book, great book recommendation. I'll have to check that one out. And this is what I love too. Again, like you've read books that I haven't, and all of our previous guests, the same thing. So I love hearing new books, and maybe that'll open up your eyes to new concepts and different experiences. Awesome. All right, next question. What would you consider your superpower to be?
I would say that through my experience as an entrepreneur, I have learned that I am good at identifying where there's a pocket of revenue to be gained. And again, as I said, when I started this company, or started my software company in 2007, there was no VC out there. We had to figure out a way to bootstrap it. So we had to be getting revenue from day one. And that's something I've probably carried through my career as I've done different things, is just being pretty good at finding a pocket of revenue.
Yeah, awesome. Awesome. All right, next question. You had a time machine. You could go back and visit 20-year-old Tad. What advice would you have for him?
I would say it is the same advice my father gave me, actually, when I was thinking about my career. So he was a journalist he went to Ivy League University. A lot of his friends became lawyers or bankers or things like that, but that wasn't his passion. What he told me is, hey, you're going to make plenty of money, whatever you do. The thing that is finite is time and passion. So do what you're interested in and the money will follow. And that certainly has been true for my career. It's been probably fortunate that stuff I enjoy is business. So there's a pretty natural link there, but I'm not doing it for the money. I'm doing it just because I find it really interesting. I think that makes you more successful. Yeah,
100%. No, I love that. I love that. And it's, as I've gotten older, you understand like time is that most precious resource. It's like we can earn all that we can, set our kids up as best as we can and whatnot. But at the end of the day, if it's not doing something that you're enjoying, like what's the point? There's just no point in doing it. I love that advice. Sage advice from Dad there. All right. And then next question. What is the biggest lesson that you've learned over your career thus far?
I think maybe I'll say the hardest lesson or the biggest mistake that I learned a lesson from, that actually was in the real estate world. So for all my talk about other assets, my portfolio is a lot heavier into real estate than you would think. For me, it's been almost entirely unintentional of buying houses for myself. And then when I move, being like, I'm just going to turn that into a rental rather than selling it. Or, hey, I really want this vacation property and I think that will cash flow. So I'll buy a vacation property I could never possibly afford for myself, but I get to use it when I want to, and then it cash flows otherwise. Unintentional real estate investor here. But I would say my first one where we bought a house and did a renovation, and I just had a dishonest, fraudulent contractor, and then we ended up moving. So I was halfway across the country trying to manage this guy who's just lying to me, and learning how to manage that horrible experience. But I think I learned a lot in terms of managing a contractors. And I think there's one thing I don't like about real estate is you kind of got to be a jerk to be successful there. That there's some great people, you can trust them with everything and they'll totally deliver, but there's a reason that so many successful people end up being kind of hard asses. And I think it's because there is a lot of bad operators in the game, and learning the importance of, in something like the software business, you're just nice to everybody. You treat everybody well. The thing is, you have zero COGS. So if you've got 99% margins, you can afford to overpay your employees. You can afford to be generous with customer rebates, but you can't really do that in the real estate game. So that's probably my learning there.
Yeah, no, it's definitely a well-learned lesson. And most of us, and again, like anybody who's in, if you're taking action at all, guys, you are going to have failure. It's inevitable. It's a part of the business. It's a part of the journey. If you're an entrepreneur, again, it's not foreign, right? You're not the only one. It doesn't make you a failure. You keep moving forward. Tad had that bad experience. That wasn't the last time he bought real estate, I'm sure. And so that wasn't the last time he probably did a renovation. Again, same thing. Learn from us. Learn from what you can take that advice and move forward.
What I like about real estate that I learned from that is, despite having literally criminal contractor and on a big renovation and all the mistakes you possibly imagine, and I wouldn't be surprised if it cost me $1 million literally in loss there, the underlying tailwind of real estate, I ended up making over $1 million of profit on that property because all of those things of, hey, I'm leveraging the money and the underlying market's going up and my interest rate is low and I'm getting rental cash flow and all that. So despite really botching it, criminal mismanagement on my part, still made money on it. So that also made me like, all right, if I can do it better next time, then my results should be better, and they have been.
There you go. There you go. Yeah, if you put it on a long enough timeline, you win. Like just the amount of money printing that they're doing, the devaluation of the currency, again, you owning assets, like, okay, you're just going to win. So awesome. Well, Tad, if our audience wants to reach out to you, they want to learn more about the community, what's the best avenues for them to be able to do that?
Yeah, it's a couple of things. If somebody's interested in joining our community, I should mention there's no fees involved. So we interview every member, but we don't charge any membership fees. And so they go to longangle.com. If it looks interesting to them, go ahead and hit apply there. That will actually set you up with we've got about 50 members who volunteer to do interviews for potential new members, which is how we make it scalable. So go ahead and check that out there. If it's not interesting to them, they just want to follow along, I do a podcast with the other guys who I run the community with called Navigating Wealth. It's a weekly podcast across we're often interviewing members who have really interesting career journeys. So start a Marine who started a cybersecurity company, or an MD, PhD who's starting a new biotech, stuff like that, learning about just interesting facets of the economy. So check out the Navigating Wealth podcast, or you can follow me on LinkedIn.
Awesome. I really appreciate you taking time out of your day to come on, have a great conversation with me, expose our listeners to your community and all the things that you guys got going on. But I've enjoyed our conversation, and I look forward to following up with you in the future, maybe to see what kind of new opportunities may be on the horizon, what you guys are identifying as potential emerging investment opportunities. And but happy holidays to you and Merry Christmas. We're recording this kind of late in the year, depending on what time you're listening to it. And cheers to an exciting 2026. Thank you, Tad.
Same to you. Merry Christmas. Happy Hanukkah.
All right. Great conversation with Tad Fallows over with Long Angle. Awesome community that they have to be able to help identify potential opportunities, alternative investment strategies, just a great leverage, again, the experience, contacts, and opportunities for a different group of, obviously they're all high net worth individuals, but I think it's super curious. Again, follow the money, right? Like you always want to invest with other successful entrepreneurs and investors. And so obviously they have some different alternative investment strategies in the sectors, which I think you could truly benefit from. So check it out. Guys, if you're interested in investing with us, you can go to tricityequity.com to learn more about previous deals that we've got on the table. Now, we'd love to be able to connect with you. You can definitely schedule a call with somebody on our team. We'd love to connect with you. If you're here locally and you want to join our networking group here, you can go to Honolulu Multifamily and More. So you can find us on a bunch of different platforms, but you can join our Facebook group as well. And of course, if you're finding value in the podcast, make sure you leave in a 5-star review, like and subscribe. We'd love to be able to continue to get these episodes out to more and more people, provide more and more value. So we greatly appreciate that, and be sure and share the episodes. All right, guys, that's going to be it for me today. I'll go ahead and sign off. We'll see you guys on the next one. Go out, take some action, read some books, go meet some new people, do some networking. It doesn't have to be our event. Just, again, anything to level up your level of connection to other people will level up your depth of knowledge. It's always going to be beneficial to you, but you got to take action. You got to step forward. So, all right, guys, we'll see you on the next one. Aloha.